if we include the dollar, commodities, and rates, and the rate of change of those, probably the largest, fastest tightening in history. And to me, my forward-looking indicators make it look like economic growth is about to be pushed off a cliff. You know, I've been using 1974 as a good guide, where growth went, where the ISM went from 56 to 30 in 4 months, and that's the kind of magnitude of what I've got in front of me. I don't think it'll be as fast, but I think it's fast, which is kind of what you're picking up. Is what you're saying is, just to interpret it for people, is what you're saying is the reason these other central banks are calling the Fed and Janet Yellen is because there ain't dollars around, because the Fed is sucking liquidity out of the market, and suddenly all of the global borrowers are like, where's our dollars? So there's a theory going around that I have some sympathy for, that after the Russian situation, the Federal Reserve and the US government essentially are going to use swap lines as a weapon. We will give you dollars, but in exchange, you need to do what we say. How are you thinking through that? Because, you know, they're creating a currency crisis here. You know, it's kind of, if we're not careful and the dollar has another 10% higher spike, I mean, we're going to create a enormous global mess. We'll come onto the banking system in a bit, but just at country level, we've got some huge problems coming if we carry on like this. So what I'm starting to think through is how similar this could be to 84, 85, where the dollar gets out of control, everybody's scrambling for dollars, playing a game of musical chairs where the Fed keeps taking away a chair, and the dollar goes much higher. So, okay, fine, you have an emerging market crisis, but I'm worried that it's also going to play into that polarization that's already going on, where China says, we don't want the dollar, enough's enough, because the dollar's not actually 87% of world trade, but 87% of world trade is denominated in dollars. So the dollar's China's problem now. And it's the same for India, it's the same for Brazil, it's the same for Russia. And if we're not careful, the dollar's demise could be caused by the strength of the dollar, which has always been my base case, that if we go up too much, people are going to have to walk away from the dollar. Do you think that we're going to need another sell-off in equities to drive this? Do we need, because right now it's been kind of messing around, not been doing much for a while, and the Fed don't feel hugely under pressure because nothing's really breaking from here. How do we get to the Fed going from, yeah, it's okay, to, okay, it's not okay, and maybe we need to readjust? Because I also think a pivot's coming, whatever that means, whether it's a pause in the QT first, which is probably the likely thing, then it's a pause in the rate hikes, and then it's we'll see, and then eventually it's oh shit, and we have to cut rates. I think the markets are priced in quite a lot, and I've got various indicators to say, look, there's possibility there's more downside, another 10%, but maybe not. The bond market feels at the wrong price for me. I think yields need to come a lot lower, but everything suggests to me that we were going to see this precipitous decline in ISM. So I went back and thought, okay, does that really matter? Because, you know, I use ISM a lot. And I went back to 1970. Every single time the ISM hit 50 or went through it, because sometimes it went from 52 straight to 48 or 40. Every time it hit 50, the Fed cut, except one, which was 2016, where they paused. So I'm like, So there's 100% track record of this suggesting that as soon as the economy goes, and a lot of the time, people were then, the obvious question is, yeah, but inflation wasn't high then. Well, it was in 2008, it was in 2001, it was in 1974. Inflation, they were cutting when inflation was at peak. So I'm like, right. People think that inflation needs to come down. Inflation expectations need to come down, not inflation itself. If you think of the bulge of all the wealth, it's the baby boomers. Right? They're in retirement, and because, unlike all the Europeans, the baby boomers are all in equities. So imagine how the 75-year-old feels when he looks at his equity portfolio and thinks, oh shit, I'm now 20% poorer, so do I have enough money to live on? So your point is, I need to stop spending money fast, because what happens if equities go down more? This is where the market really splits. I think everybody now agrees, okay, recession looks pretty bloody likely. Magnitude, duration, nobody knows yet, but we're all trying to figure that out. The hard puzzle is 18 months' time. My base case is inflation goes negative, but we need some factors. I understand the commodity supply story. I understand the supply chain story, but I think those are mitigated by demand destruction over a period of time. And therefore, if oil, I think oil goes to $60. Maybe I'm wrong. Maybe it goes to $80. But if it's down and stays there, then the year-on-year rate of change of oil is going to be massively negative, as is it for copper, as is it for foodstuffs. They're all the same. So there is an optical chance of getting that down. Do you get core inflation down? I don't know. People skewing wage growth, because wage growth, too many people are retired. So the people in jobs, there's less of them, essentially, because of the issue of the baby boomers. And the baby boomers don't get wage rises because they're not in the labor force. So I'm not so sure that we get that. But right now, that's not the macro game we have to worry about. The macro game we have to worry about is the next kind of 12 months where it's super interesting. Now, I want to ask you about something, because you pinged me an email about, listen, I'm a little bit worried about the banks. One of the things that I've always said about this market, and this is right in your wheelhouse, is equities, bonds, all of this stuff. It's not just investments, right? Most people think of it as investments. The average retail person, it's their investments. But you and I also understand it's collateral. And it's the collateral for the banking system. It's the collateral for everything. And you pinged me with an email saying, listen, I'm getting a little bit worried about how banks deal with this and the credit cycle. Talk me through your thesis on this. Because I think if you destroy collateral like this, you create an issue. We just saw this in crypto. Once the collateral goes down, suddenly a whole bunch of debt gets liquidated. What they're trying to do is say, we understand what we're going to do. If we can bring forward expectations, and there's a lot of charts now to show how far some of these expectations. I think the Bank of America survey came out, well, somebody posted on Twitter today, and from the investors, the expectation of CPI is utterly collapsed. So we're getting into that zone where the Fed get comfortable to say, well, if we brought future expectations down, then it will be transitory. Whether it is or not, we will find out. The other side is my forward-looking indicator for ISM suggests it hits 30, which is like full tilt recession, but it does it really fast because of this tightening, right? It's just the tightening put forward by 2 years or whatever it is, and it just shows this, and it's been an amazing indicator. If the ISM, let's say it doesn't go as far as 30, let's say it goes down to 35, 40, I think that's enough to lower prices. So if you say, well, real estate's going to come down, we're already seeing the home builders coming down. We're already seeing copper coming down. We're already seeing Baltic freight. We're seeing, in fact, all commodity complex. Oil's still a bit sticky, but it's come down. So that's the last shoe to drop. Wages are always lagging. Owner's equivalent rents are always lagging. But if property prices are coming down, they're coming down. So I'm like, well, where is this inflation going to get generated from?